Takeaways from your trip to Beijing and Shenzhen.
Hi, Yvonne. Let's recall what we discussed about 1 month ago in your show. Liquidity was in driver's seat. We have seen some kind of water buffalo forming. So that liquidity net narrative was dominating basically every single speaker on your show in the last month or so. But we have also warned about a month ago there is a disconnection between fundamentals and this liquidity narrative. August prints are very soft. High-frequency data like housing, exports, fiscal impulse are all fading. So back to fundamentals, I would argue what happened in the market is more like a reality check. It's not a broad reflation yet, and we have seen that modest policy moves, as your colleague John in Beijing mentioned, some marginal easing in monetary and fiscal policy, but these are more cyclical tools which can cushion. To have a new cycle, you need structural moves to anchor reflation and rebalance. That's not these marginal easing tools. That's probably the upcoming fourth plenum and the 15th five-year plan outlines. That's the key swing factor we are monitoring.
What's the likelihood, though, that we get anything major from that? I mean, a lot of people have been saying also the rally that we've seen in Chinese equities has sort of removed some of that need as well for big stimulus measures.
Well, I would argue they need to reflate the economy with much stronger consumption-centric policies. For example, if they use the five-year plan to change the government incentives, to recalibrate the fiscal policy, to put all these resources into a stronger social safety net, that could unlock consumption in a more sustainable way. So that's the five-year plan to be announced by the fourth plenum. That's the key swing factor. Before that, we will keep hearing incremental, modest cushion measures, be it this fertility support or subsidy on services consumption, or some accelerated pace on vetted infrastructure spending. But these are more like providing a cushion.
There was this sort of meeting that the CSRC Wu Qing had with industry experts and the like recently. And what do you think has changed in terms of how regulators looking at this rally? Because, up until now, it seemed like they were focused more on stability, especially amid the face of tariffs and the like. And now you're seeing even like policymakers nudging towards a stronger RMB to help with inflows in some ways to the equity market as well. Has the role of the equity market changed from a policymaker's point of view?
Well, I think policymakers probably see the equity market as a very, very excitable dog on a very long leash. So it does, on random directions. But eventually, the policy guardrails, which is the leash, can bring it back. So what happened over the last 2 months, the debate over liquidity-driven market, the so-called deposit migration thesis every speaker on your show mentioned, I would taper expectations because the size of this excess saving in the last few years is probably smaller than most people imagined. Only RMB 6 to 7 trillion excess time deposit over the last few years. And more importantly, the pace of migration, outflow into equity is much slower than the market imagined. July, August, probably only 300 billion yuan migration at best. So it's quite slow. Why? Because many market entrants in 2021, they are still underwater. That precautionary saving is still elevated. So I think back to fundamentals, you need broader reflation that pulls through to wages, to employment. That can make this rally much more sustainable. And for policymakers, the signal has been providing guardrails, not bricks. So they probably act earlier, more targeted than previous boom-bust episodes. So now they are using some pro-market reforms plus some window guidance to provide guardrails. I think that's not bricks. And the market, as you mentioned, kind of did the self-correction by itself. So heavy-handed intervention is not necessary.
It's interesting as well. I mean, yes, maybe it's more led by smart money, less by sort of retail money. That's sort of the theme that's come out. But also the questions around what is the next leg of the rally, and the earnings results we've seen don't really justify any big move higher from here. When you also combine it against stories like Yvonne was saying about Reuters reporting that BYD has cut their sales target for EV sales. I mean, that's not a great signal either about the health of the economy. So, I mean, how much worse do you think the economy will perform going into the end of the year?
Well, we have a soft second half forecast. And more importantly, deflation is going to be persistent. So China started this anti-involution campaign, and we did a deep dive. Solar sector is probably exhibit A for anti-involution. There seems to be a plan starting with upstream, like polysilicon, with a consolidation plan financed by some industry funds to absorb inventory, to smooth the supply curve. But solar is probably the most easier one. If you look at the downstream, cars, e-commerce, express delivery, these are much tougher because the fragmentation of market share, because policymakers have this less policy levers on these sectors. So it's not going to be easy. It's more like a messy path, maybe 2 steps forward, 1 step back, that kind of path, rather than a straight line for reflation. Our base case is Chinese growth will still be with subdued nominal growth, deflation throughout maybe the end of next year. But if we talk about micro story, because Yvonne, you mentioned our trip in Beijing and Shenzhen, there's some divergence in Shenzhen. It's all positive micro story. Things like the green tech, EVs, and the transitions like power storage, power grids, and also the smart manufacturing, like using AI and industrial robotics and the software that make them more efficient, improving cost benefits. And last but not least, these new so-called new productive forces, humanoids, self-driving cars, and AI adoption. You also mentioned the DeepSeek new model. So I think there is a lot of micro positivities. It's just that these are not enough to have a full pull-through to wages and employment for reflation, not yet.
You mentioned that fiscal expansion is limited. Why do you think there's not that much room? And how bad does it have to look for the economy in the fourth quarter to actually spark some sort of fiscal expansion, you think?
Well, the reason is simple. With the first half GDP tracking at 5.3%, for Beijing, the bar for much bigger deficit expansion or much more aggressive rate cuts is quite high. It will be data dependent. And if the third and fourth quarter data softened more than they expected, it's possible they will do some monetary and fiscal easing in Q4. But again, these are more incremental targeted easing, like cyclical tools providing a cushion rather than using structural reform to anchor rebalance. That's the 5-year plan and the fourth plan. Before that, I think any additional fiscal easing will be quite modest.